Ever thought about how much money you should save for retirement? Well, you're definitely not alone in this. Figuring out the right amount to save for your retirement is a common question that many people want answers to. While looking at the average retirement savings for people in your age group can give you a rough idea, it's not the only thing you should consider when deciding how much money you need to stash away for your retirement years. More and more Americans aged 55 and above are choosing to retire, with roughly half of individuals in this age group deciding to leave the workforce. Interestingly, some are even making a return to work due to the impact of inflation and unpredictable market conditions, which are affecting their retirement savings. This trend might prompt you to contemplate your own retirement plans, regardless of your current age. I'm Will, and I teach people about investing, personal finance, and money. I've walked the path you seek, and today I have several businesses and investments that provide me income every single month, meaning I never have to work another day in my life. If you plan on becoming financially free, be sure to subscribe to the channel and hit the like button if you find this video valuable. So how much money should you have saved for retirement by age? In your 30s, establishing a solid foundation for retirement savings is essential. Aim to have saved at least twice your annual salary by this stage. If, for instance, you're earning $50,000 per year, your retirement savings target should be $100,000. To make this achievable, consider setting up automatic contributions from each paycheck, allocating a specific amount towards your retirement fund. If your employer offers a 401k or a similar plan, take advantage of it, especially if they provide matching funds. Contributing the maximum allowed amount can significantly boost your retirement savings. As you enter your 40s, the goal is to have 3 times your annual salary saved for retirement. With approximately 25 to 30 years remaining until retirement, there's still a considerable time horizon to accumulate wealth. Regularly reassess your retirement goals and contributions, ensuring that you stay on track. Don't wait until significant life events, such as your children graduating, to make those adjustments. This age presents a golden opportunity to make significant progress towards securing your retirement if you haven't done so already. By the time you reach your 50s, aim to have saved 6 times your annual salary in your retirement account. This is a critical juncture where closer scrutiny of your retirement savings and investment strategy becomes imperative. Consider rebalancing your portfolio and shifting towards 50 to 60% lower risk investments as you approach age 65. This adjustment aligns with a more conservative approach to protect the wealth you've accumulated, recognizing that you may have less time to recover from market fluctuations. Regularly reviewing and adjusting your retirement plan in your 50s is crucial to ensure your financial security in retirement. But if you're not quite on track, don't worry, as I'll share what you can do if you need to round up cash urgently. As you enter your 60s, the target is to have accumulated 8 times your annual salary in your retirement savings. With retirement on the horizon, it becomes crucial to adjust your investment strategy. Consider reducing your exposure to stock funds to 30% of your portfolio, opting for a more conservative allocation to protect your wealth as you approach your retirement years. Additionally, if feasible, delaying the start of Social Security benefits can be advantageous, as it may result in higher monthly payments. This strategic move allows your retirement savings to continue growing while providing a more substantial income stream when you do start receiving Social Security. By the age of 70, the aim is to have saved 10 times your current annual salary, marking the culmination of your retirement savings journey. For instance, if your annual salary is $120,000, your total savings goal would be $1,200,000. At this stage, you are ripe for retirement, and your accumulated savings should provide a secure financial foundation for your post-working years. Regularly assess your financial situation, including your retirement accounts, investments, and Social Security strategy, to ensure you are well positioned for a comfortable and worry-free retirement. However, when it comes to retirement savings, let's not forget that every individual's situation is unique and shaped by variables such as income, unexpected expenses, broader financial goals, and potential health conditions. Considering these factors is crucial for tailoring a retirement plan that aligns with your specific circumstances. If you're enjoying this video, smash that like button, as it really helps the channel. Thanks. Now, what if you find yourself in need of urgent cash? Well, I've got some tricks to teach you. However, this trick is not for everyone, especially seniors or those close to retirement age. So, to free up cash, here are 3 alternatives to consider. Number 1. Life insurance cash out. Whole life insurance policies present a unique avenue for policyholders to access quick cash when needed. Unlike term life insurance, which solely provides a death benefit, whole life insurance incorporates a cash value component that policyholders can tap into during their lifetime. This cash value accumulation allows individuals to cash out a portion of the policy, essentially converting a part of the death benefit into immediate funds while they are still alive. The flexibility of whole life insurance allows policyholders to utilize these funds for various purposes, such as covering unexpected expenses, managing financial emergencies, or even making significant life investments. It essentially serves as a financial safety net that policyholders can turn to when the need arises. However, it's crucial to be mindful of the implications of cashing out a portion of the policy. Any amount withdrawn from the cash value is essentially a loan from the insurance company, and it needs to be repaid. Failure to repay this loan can have consequences on the eventual payout to beneficiaries. If the amount is not reimbursed, the death benefit paid to loved ones upon the policyholder's passing will be reduced by the outstanding loan amount. Number 2. Cash out refinance. Homeowners have the option of a cash out refinance, whereby they take out a new loan exceeding their current mortgage balance. This new loan pays off the existing mortgage, leaving the difference in cash for the homeowner to use. The refinance replaces the current mortgage, and the borrower will repay the new loan monthly, including interest, until it's fully paid off. While these options provide immediate access to cash, it's crucial to carefully evaluate the implications and potential long-term impacts, especially considering the stage of life you are in. Consulting with financial experts or advisors can offer personalized guidance based on your specific needs and circumstances. Number 3. Reverse mortgage. Another option available for homeowners 62 and older is the utilization of reverse mortgages. This financial alternative is particularly advantageous for individuals who have either fully paid off their mortgage or significantly reduced the mortgage balance on their homes. With a reverse mortgage, homeowners can tap into a portion of their home's equity, providing them with a source of tax-free income. The appeal of a reverse mortgage lies in its flexibility. Homeowners can receive funds in various ways, including a lump sum, monthly payments, or a line of credit. Importantly, these funds can be used to meet immediate financial needs without creating a taxable income. However, it's important to understand that a reverse mortgage is not a one-way street. While it offers a valuable source of income, it comes with certain repayment conditions. Typically, the borrowed amount, along with accrued interest, needs to be repaid if the homeowner passes away or decides to sell the home. Despite the repayment conditions, a reverse mortgage can be a viable option for those in need of immediate cash, especially if they plan to remain in their homes for an extended period. It's essential to carefully consider the long-term implications, potential costs, and impact on inheritances before opting for a reverse mortgage. Seeking advice from financial professionals can provide valuable insights and help individuals make informed decisions based on their unique circumstances. Overall, planning for your retirement is a big deal. It's one of the most major money goals you'll ever set. Picture this. When you decide you've had enough of working or just don't want to anymore, having a good chunk of savings becomes crucial to keep up with your lifestyle. That or a decent monthly income from passive investments. Take a moment today to check on your savings. If you're on the younger side, think about starting a solid savings plan. If you're older, maybe adjust your savings game a bit. The key is to be good about setting aside some money now to make sure you have a financially sound future ahead. Whatever your plan, I suggest you watch this video next on 7 major mistakes people make before retirement.